Good afternoon. How is everyone? Can I get a little mic check? Not a big mic check, just a little one. Finnegan, winner. uh, yeah, Michael, that's a great point. I mean, all you really need is level one options. Um, and you can do great with a lot of these plays. Generally, we're just buying and calls and puts. D-Mac, you just took a put sniper. Yeah, did you catch that flush right there? Well done. Hopefully you flipped it out at VWAP here for your profits, or you had a profit target already put in, because that's a quick bounce right there. Well done, well done. Well, that's a good question, Bill. There is a thing called. Let me see if I can pull it up here. You want to know where I think the SPX will close? Let's see. Well, let's see where max pain is. Hold on a minute. Maximum pain. Okay, here is. Where is it? Oh, it's giving me weird SPX. Yeah, I think you have to go XPXW. Hold on just a minute. I might be able to answer that question. No, I want 913. So, well, I don't think we're going to hit that. So max pain for this week's expiration is way down. What does it say? 55. Oh, no, it's not. It's 55.40. So max pain is about right there for today. So we would have to hit max pain. We would have to have a pretty serious rollover down to this line right here. And I'm just using a site called maximum-pain.com. And you pick your expiration, and it gives you the expiration date, and it gives you that time, that value. That's where the most people will be in the most amount of pain based on options activity. But that would have to erase 2 days worth of price action. So I don't think that's going to happen into the close. I think we kind of go sideways into the close, frankly. That's my thought. So what I wanted to come on, I'm actually going to do a lesson, okay, on calculating risk reward and options. So using options, right? So if you're interested in learning how to calculate that sort of a thing, pull up your Roku chart. We're going to use Roku as an example. And then also pull up your Roku. Let's see if I can get it over here real quick. I want to grab, there we go, your option chain for Roku. Okay, so this is going to be a lesson on calculating risk reward using options and the chart. Okay, so basically the way we calculate risk reward using the chart is, let's say we wanted to get into Roku right now. Okay, I think Roku's a little extended, but this is just going to be a good example. Okay, And we think, we're targeting, a move up into 77, right? We're targeting a move up into, I'll put a line there, right? That's our target area. And we think that this lower value area low, this yellow line here, is where we would stop out, where this trade falls apart. Okay, we could even play down to this point of control, this red line. So if we want to calculate that, we can just look at it and we can say, okay, if I'm going to stop out at 73.96, where this red line is, if I take a trade right now, right, and my profit target is 77, right, and I'm sitting at 75, okay, I am risking $1 to make $2. Okay? That's over here on the underlying stock. 77, we are at 75, or roughly 75, right? I'm risking down to 74. So I always say this in reverse. You're risking 1 to make 2. Okay? And you always want to be, in my opinion, a 2-to-1, if not 3-to-1 reward to risk. Okay, and I always say it. I always just say it backwards. The phrase is risk reward, right? But I always say my reward first. So when you hear me say it, sometimes it can be confusing. Okay, so I'm risking $1 in the underlying stock. So if I was playing the stock, I'm risking $1 to make 2. Okay. How did I pick 77? I picked 77 because I needed a good example here. Okay, and it's a round number. I could have picked 80 if I wanted to, right? I'm just showing how to calculate a risk reward. So, you could jump over to something else. You could, let's say we were playing Toll, right? And you wanted to use something like Fibonacci. So you use your fib extension up to the 1272. Now I have a target at 50, 150, 55, and I'm playing at 149.80. And where my stop loss would be down here. So in this case, right? In this case, we've used an actual 1272 extension target. And if my risk right now was at 149.80, where I'm putting on the trade, and my target was 150, let's just say 150.80, right? Let's just, for ease of use, let's just move that up a little bit. Okay, 49.80, 150.80, but then my stop loss is down here at, let's put it at the bottom of this chart, 148.58. Now that's not even a 1-to-1, right? I am risking, more, probably 1.2 to make 1. Okay. That is a bad risk-reward setup. Okay, we always want to be in that 2-to-1 range, 3-to-1. That way, we can still be, if your wins are $2, let's say you're a 2-to-1, right? If your wins are $2, your losses are $1, you can still be a 50% accurate trader, and you're a profitable trader. Okay, so, but in this Roku example, I'm just picking the reason, and you'll see why I'm picking this here in a second. Okay, because this is going to make this pretty easy. Okay, now we moved all the way up into 75. So this example is not the best because when I was calculating some of this stuff to talk about it, we were down here at 75. So let's put the replay function on, okay? And let's bring us down here into this. Let's say we're at 74.53. We're targeting 77, right? And our stop is down here at 73.70. Another thing we can do is use TradingView has a feature called a long position and a short position. And if we already know where we would like to hit our stop and we already know where our target is, and we're looking to see, let's say I want to put this trade on right now, I can put this box on the chart and it puts it right at my entry point, and then I need to move my stop loss up, and then I need to move my target up, and then I can see what my profit loss risk reward ratio is, right? And so that says, it's kind of probably hard to see here, but that'll show a 2.86 risk reward ratio, which means, you know, I 2.8 to 1 basically is what I'm risking here. Okay? And then if I want actual dollar amounts, I'm risking 85 cents to make 243. Okay? So that's great. This is if we were putting on this trade, this would be a good risk reward ratio as long as I was, you know, willing to take this off when I hit my target, and if I was willing to honor my stop. All right. But let's figure out how to calculate. That's great if we're playing stock, right? If we're playing the underlying stock, it's really easy to say, okay, for every share, I'm risking 85 cents, right? That seems pretty easy. So if I'm just going to move this forward a little bit because I want to make this example super easy, just so we can calculate these values. So I'm going to put the replay back on, and I want to see if we put on a trade right here. We're risking $1, right, to make 228. That's still a good risk reward ratio. How can we calculate that when it comes to options? Okay? Because when you put an option on, you're not buying a $74, $75 option, right? You're buying an option contract depending on your time frame, right? And so let's say, for instance, let's look at the September 20th option contracts, and we're going to look at this kind of around the money calls. So the $74 and the $75 calls, okay? Right here. Now that's probably kind of small for you to see, but the $75 calls, the lower one, you can pick those up for, you know, in the neighborhood of, you know, $1.82, right? That would kind of be the mid there. That's 176 and 187 per contract. Now, each contract is representing 100 shares, so, you know, that $1.77 is going to be $177 per contract. Okay, so everybody kind of understand that? But there's a number here that I want you to look at if you're pulling these contracts up, and you have to make some changes, but you want to be able to see your delta. Okay, my delta is way over here on the far left side of this. Maybe I can make that a little bit bigger so it can actually read. Oh, there we go. Read as delta. Come on. Okay, so if I open this up, I'm going to make it a little bit bigger. Okay, so the $75 contracts calls for September 20th, right here, have a delta of 0.50. Okay, and that means that for every dollar move in the underlying stock, that's this over here, for every dollar move, this option contract is going to move 50 cents, right? So, and the reason you can tell, you can also see that, right? If this is, if the 75s are $1.84, then the 74s, which would be moving in the right direction, moving $1 up, right? Those are going to be 50 cents or roughly 50 cents higher. Okay? So, and you can see out of the money, they start to, that delta gets lower. 42 for the 76s, 34 for the 77s. If you go the 74s, it calls, they're 59. That's almost 60. So the more in the money you are, the more they're going to move in value with the actual underlying stock. So let's say for ease of use, we're going to use the 50s. Okay, we're going to use the 75s. All right. And we want to know here on Roku, we want to know, we're going to use the 75s, and it's going to, let's say it's going to cost us $1.80 per, right? And our stop loss is exactly $1 less, right? So if we're willing to put this on, right, what is our option contract going to be worth if it comes all the way down to this 73.70, which is $1 lower? What is our option contract going to be worth? Right, $1.30 per option contract, right? Because it's going to lose 50 cents for that $1 move. Okay, so if I'm buying these at $1.80, right, that means for every contract I'm buying, that's $180. Make sense? Okay, and if it drops to here, that's my how much I've invested, right? If it drops down to our stop level, that will be worth $130. Right? So if I'm not willing to risk more than $50, this is not right. So I've calculated my risk. I've figured out that a move per contract would move me right down into $1.30, which would mean I'd be losing $50. So if my max loss, I mean, let's just say, for instance, my trading rules were $1,000 is my max position size. Okay, so for my max position size of $1,000 and my max risk, okay, my max risk is $200. So these are my trading rules, and they can be, I'm just picking nice, huge, random numbers, okay, to try and make this as easy as possible. This could be 10,000. This could be, 500. Whatever. This is your max trade, and then you're only willing to risk or stop out at a $200 loss. Okay. So in this scenario, right, and these are $1.80 to buy, right, with a 50-cent stop. So with your max purchase of $1,000, how many contracts can you buy? Yeah, you can buy 5, maybe 6, depending, right? But 5 for sure. Okay, so if you buy 5 contracts, and each contract is going to cost you, if you come down to your max loss, 50 cents, does that stay within your $200 max loss? No, it doesn't, does it? So if you buy 5 of these contracts and it comes down to your stop loss point, you are risking $250, right? And so if you've exceeded your max risk, so understanding what you're risking changes this trade, doesn't it? So now how many contracts can you take at $1.80? Right. If this is your risk parameters, you can only buy 4 because you're risking $1 here at a 50-cent. Okay? And you don't want to exceed your $200 max loss. So that's how you can calculate that. Now, this is like the dumb simple. I don't mean it, other people are dumb. I'm saying, like the sort of that keep it simple. There are many other factors, right? We are looking at next week's options. If this thing just kind of kept going sideways, that this option contract at $1.80 is going to deteriorate based on theta. Okay, theta is time decay. If we get some sort of event in the market and the IV goes up, this 180 could go up. But all things considered, that's that kind of the quickest, easy head math way to figure out, I could put on $1,000 here, but if I do, I'm risking $250, and that would mean you were stopping out right here. And how many of us actually do that perfectly? Right? Many of us go, well, it's come down here. Now it's down. Oh, I think it's going to bounce. Okay, it's going to bounce to here. Oh, no, it's rolling. And, oh, shoot, I'm taking it off down here. And now I'm, at a $400 loss. Now, that's a different conversation because that's a psychology conversation, and learning to cut losers when they reach, they break the level that you've previously assigned as your stop level. Yeah, it's a different conversation, but this is how you can do a quick calculation, and it's not perfect, right? It's not that this isn't going to get to here, and you're going to see exactly minus 200 in your portfolio, but it's going to be close, and especially if it happens, in a very quick time frame. That's going to change as time goes, like if you were buying same week options and it takes 3 days for this trade to happen, that's, that theta increases as you get closer to the expiration, right? And so it speeds up more rapidly the decay of your option. And next week we can do a whole session on theta and how to kind of, you've heard the phrase, when in doubt, go further out, because the further out you go in an option contract, the less theta decay you're going to have to worry about. Okay, so I'm gonna erase what's on this screen real quick. So I hope everybody understands kind of what I was doing there. But today's options, today's $75 options expiring today are 16, 17 cents because they expire in 1 hour and 30 minutes. Okay, so you're paying more for time, right? The 75s that we were just talking about are 171, 182, so you could probably get those for 175 right now. The 27s are 250 to 270, so you get those for 260-ish, right? And the further you go out, you're paying more money, but you're paying more money because you're buying more time. Because these start to deteriorate faster as you get closer to the expiration. Okay? So that's kind of a quick lesson on how to calculate your risk. Both in the what's my risk reward ratio And then also, how does that play into my option contracts? And what am I literally risking from a dollar perspective, so I can stay within my risk parameters? And you've heard me talk about this week. You have to learn to set a plan. Okay, even if it's somebody else's trade, know where the stop is and know where the risk is for you. Right? And we've all been caught on the wrong side of theta. That's why when an option goes against you and you wait, and it starts to come back, right? This thing goes all the way down to here, does this, and then by the end of the week, it's back up here, but it's not worth what you bought it for. Not even close, especially if it's a short dated option. In fact, you're probably, if it's a short dated option, you're probably still near zero right here when you paid, 180 here, because of the time that it took to do that, right? And so that's why lottos are great, because if you buy a lotto for short dated expiration and it goes like that, you're making money fast. But if it goes against you, it's basically, you have to be willing to lose whatever you're putting into it, right? Because the theta decay is it's gone. It's gone. So, does anybody have any questions on that? And you can do this on any one of these underlying stocks, and learning to look at the delta on the option and figuring out. That's why, if you can and you have the money to do so, buying something in the 90s to a full 1, right? Then you're getting a dollar for dollar move in the option, in the options that you're playing. I just say it that way, Gentriel. See, look, I know it's confusing, but so like when I click on this, it's called a risk reward ratio, right? But I always say 4-1, or 2-1, because even here, this tool says risk reward ratio, but it's a 2.28, which means it's better than a 2-1 or a 1-2. But as long as you understand that you want your reward to be bigger than your risk, you can say it however the hell you want to say it, right? And I said at the beginning of this presentation, I do say that in reverse, because I like to think about my reward. And yes, this was recorded, and I will get it posted up as soon as we're done here. But going through lessons like this and learning the intricacies of options and how they react to time and movement and volatility in the market really helps inform trade decisions. And it's something that you have to kind of experience and play around with, and sometimes make mistakes with, but that's the benefit of being in a room with other people. Right now, I'm not planning on doing any sniper trades. No, there's an hour and a half until the market closes on a Friday. I've made my money for the week. I'm 3 for 3 today on snipers. And I am probably going to sit and listen to D-Man for a second. And then we've got our Three Amigos session to close out the last hour of trading. It's been a great week. And if you were in earlier, don't lose your ass on a Friday. Don't try to be a hero if you've had a great week. Don't try to be a hero if you've had a bad week. One of the worst things you can do is come in on a Friday and either try and make more if you've had a good week, or try and make it back if you've had a bad week. And then you just potentially crush your ability to have a nice weekend, because you sit there through the whole weekend thinking, God, I gave away all my profits on Friday. What a dummy. Or, man, I thought I could make it all back on a Friday and I lost even more. Right? That's why you see D-Man doesn't trade much on a Friday. Nate has stopped. He's had a great week. He's toning it down. He's just kind of looking for setups for the following week. It's just one of those things that you kind of do as a professional trader. So anyway, I hope to see you guys in here next week. Like I said, we're going to do a bunch of lessons on the basics, right, throughout the course of the next 2 weeks. This is the list that we made in our earlier session. And, so for those of you that want to kind of get a handle on this stuff a little bit more, we're going to be here for you, and we're going to give you the basics. So I hope to see you all in here, and take advantage of that Victory $100 off before midnight tonight. I know there's a bunch of new people in here, and I'm really, really excited for next week. So, D-Man, are you in? Paging Mr. D-Man. White courtesy phone. All right, you can just grab it from me when you're ready, buddy.